Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are February the 11th, Tuesday of 2025, recording this in the morning. Okay, so the main overnight news, there was not a huge amount going on, but we did have yesterday afternoon. We had Trump, apparently putting 25% tariffs on steel and aluminium imports coming into the US. Obviously, this is going to be quite good for sort of domestic steelmakers in the US. Although, if we go back to his first period in office, that sort of bump effect only lasted not a long time for US steelmakers. Of course, the problem is that a lot of industries in the US use steel, so for those directly making steel, it might give them a bit of a bump in terms of cheaper products. But for the vast majority of sort of industrial concerns in the US, this is not necessarily great news. However, it seems to be sort of a fact. Something which is kind of interesting just to see here, so looking at this, where does the US get most of its steel from? And you see that really what's very affected is Canada, which seems to, it has about 25% of imports coming into the US that come from Canada. And aluminium is actually more. I think I read somewhere, I think it's about 45% or so. So the point is, this is not great for Canada. We'll see if Canada responds. There's been some sort of strong words coming out of the Canadian sort of caretaker Prime Minister, Justin Trudeau. But the reality is, it's not great for the Canadian dollar and the Canadian economy. And I guess the takeaway is to say that these Trump tariffs, although they're being rolled out in a sort of ad hoc and slightly chaotic way, it does seem that the general direction of travel is to put on more tariffs. Trump today also talked about yesterday also talked about reciprocal tariffs, so that if anyone puts tariffs on the US, then they would be tariffed in kind. But as you guys can see, actually, I've got a little graphic here. I think I caught this in. A lot of it is oh no, I don't seem to have that. Anyway, the point is a lot of it's from sort of smaller countries in the emerging markets, a lot of African countries, some Asian countries who are sort of putting more tariffs on US imports than vice versa. And so the idea is that if Trump does go ahead with this sort of reciprocal tariff imposition, this could be quite nasty for emerging markets. So keep an eye on the chart of EEM. Let's actually have a look at that, and we'll look at the Canadian dollar just to see a little bit how certain things are reacting to that. So the Canadian dollar is down a little bit. You can see here against the US dollar, but not a huge amount. As you guys can see, this was the initial sort of tariff news about a week ago, which subsequently was sort of walked back by Trump. So as you guys can see, US dollar trying to sort of, get a little bit higher against CAD, but essentially just trading in a range here. And what we can actually see, more to the point, is that the US dollar, as you can see, it's not really ripping at all on this tariff news. And I think it's slowly dawning on the market that, this constant tariffs is providing uncertainty. At the margin, it could be inflationary. And overall, it's not necessarily a straight sort of positive for the US dollar. Just looking also at emerging markets, just want to keep an eye on that chart there. So here's the EEM, which is the emerging markets ETF, down in the pre-market, down a little bit. So what we can see here is that's popped a bit higher, but I think that's going to be under a little bit of pressure if it turns out that Trump will start sort of putting more tariffs on countries like Vietnam and Brazil also, which have substantial trades deficits with the US. So that's definitely one to be looking at. Just in terms of the US dollar and what's going on there, there's this idea that inflation is relatively not elevated, but relatively sticky, and it's not getting down to the Fed's target. There's a lot of geopolitical risk. There's uncertainty. And if we actually start looking at gold, let's look at gold, because gold, as we all know, is absolutely is ripping. It's on a tear. I mean, let's just look at the spot price here, coming down just a little bit this morning, but essentially we're in this up channel and then in a much greater sort of up channel here. And I think probably that coincides the top of that up channel with about the $3,000 mark. So would not surprise me if gold gets up there. But it's just sort of interesting to look at a few different charts and sort of maybe think about that. And I think gold at this point is turning into sort of, it's turning into a lot of things. So I've got just a few little charts here which I dug up. So you can see here that if you look at the gold CPI ratio, you can see that even adjusted for inflation, gold has been performing incredibly well. And if you look historically here, you'd have to go all the way back to the late 70s to get a similar kind of performance. So gold definitely, at a certain point, we know that gold does not pay interest. It costs money to store and to insure. And so historically against real yields, the logic has been that as real yields have gone higher, so that's, for example, the nominal yield subtracting the rate of inflation, it's what you really get as a return. As real yields go up, gold traditionally has suffered because it doesn't offer a return. But what's quite interesting is that at the moment real yields are pretty high because we have a nominal yield of about 4.75%. Inflation, let's call it 2.5. So you have a real yield of anywhere between 2.5%, depending on how you calculate it. So ordinarily that should have been a headwind for gold, but we can see here that gold versus CPI ratio is going up a lot. We can also see here, and then again, this is getting to the real yields. If you look at the TIPS index here on Bloomberg, so the TIPS is the inflation protected, the Treasury inflation protected securities, which are essentially at the real yield. You can see here that gold has almost been on a parabolic kind of sort of upswing, whereas TIPS is it's been going up, but not nearly as much. So that traditional relationship between gold and real yields, which usually was inverse, is actually sort of breaking down a little bit. Now, why is that? Again, inflation hedge, but also you got to look here at the dollar. If people start losing a faith in fiat currencies and the dollar in particular, gold seems to be sort of the safe haven of choice, especially in sort of countries like India. You've got Pakistan, the Middle East, China. Turkey, Japan. I'm just thinking of all these countries. If you look at gold priced in those local currencies, you'll see it's even more extraordinary performance, even compared to priced in US dollars. But have a look here. This is the dollar index, which is essentially kind of flat going back for the last 2 or 3 years. But look at the dollar priced in gold terms. So imagine if, the relationship here, the ratio of gold and the dollar. So what this is telling you that the fiat like the dollar is doing okay against other currencies, but these are fiat currencies which are also being devalued and debased and are losing their purchasing power. All fiat currencies are losing their purchasing power. Just think about what you could buy 10 years ago in your whatever is your local currency, and then think about it today. So gold is actually performing here as a hedge against the debasement of fiat currencies. Some people argue that, of course, crypto, Bitcoin serves the same kind of thing. Other interesting thing here is that it's definitely buying by central banks. Now, we know that after Russia's invasion of Ukraine, that the U.S. administration at that point tried to sort of weaponize, assets held in U.S. dollars, treasuries, other sort of liquid assets. And so we've had a huge amount of buying by central banks, especially the Russians and the Chinese. And you can see here the Chinese gold reserves in the white here. But also look at India, for example. This is the India gold reserve. So a lot of these countries like Brazil, Turkey, India, China, Russia, the central banks are definitely allocating more and more and more of their reserves to gold. And gold's a relatively small market in nominal terms. So it just takes a 1 or 2% reallocation to really give gold a push. And you can see here that, for example, the Chinese have started buying. And I'm just going to grab some tea here. English breakfast this morning. And so what we have on here, we just had the numbers coming out last Friday, actually. This is, you see the top left, China monthly gold reserves. And what you guys can see here, you see the net change. So China basically in this period, if we go back, what you can see if you go back before the invasion of Ukraine, so you go 22, 1920, 2021, 2020, look at the net change here, 0, 0, 0, 0. But what we can observe, if I can find this, yep. So what we can observe is that basically in the latter half of 2022, the Chinese obviously made a concerted effort. You can see the percentage change. Look at this. They started buying massively. This represents, an extra percent essentially every month, 0.5%, whatever. So they started to really pump up their gold reserves. And then what you can notice is that for about 6 months here, they stopped buying. So the Chinese are a little bit sensitive to price, so they stopped buying. But what's interesting is that since essentially November, these are the publicly available numbers, they've started buying again. So we've got 16 basis points, 33 basis points, 16 basis points. That's the net change. in ounces, and this is in percentage terms here. So this is actually so we've now got the point that the Chinese central bank you can see here is definitely buying a lot of bullion. They seem to be maybe not as price sensitive, although the quantities are not quite as much, but they're still buying even up almost towards $3,000. So kind of interesting there to see what's going on. I think gold, any dip at this point has to be a buy. The other interesting thing, hold on, let's get back to these graphs here. So you see, yeah, what was I going to show you here? It's also just what's going on with silver. Silver, as you know, historically is very, very correlated to gold. But it has been underperforming a little bit, and that's probably because about 50% of silver usage is not purely for speculation or as a reserve or jewelry. It's for industrial uses like solar panels, batteries, and other industrial processes. So the silver cycle is a little bit more sensitive to the industrial cycle or the silver price. So if we actually look at silver here, so let's just look at gold, and you can see here, very, very strong performance. If we look at silver spot, we can see it's actually sort of been underperforming here. And you see here on this, it looks like a fib retracement here. Yeah, basically 61.8. So you see here the 61.8 just having a bit of a retracement. But let's say, for example, this comes down. I would say an interesting price could be this cluster of moving averages here, which also, that's the 20, the 50, and the 100 EMA, which also coincides with the nice horizontal level. I would say anything around about $31.10 to $31-ish. If gold comes back down, has a nice little retracement, let's say back down here, and silver, this could be kind of interesting as a buy for silver. Although, keep in mind, Trump has talked about sort of extra tariffs on metals. And if there's some sort of fear about a slowdown in industrial activity globally, maybe that's going to weigh on silver as well. But the reality is, as long as gold is pumping higher, that should drag silver with it. So definitely a very, very interesting one to look at. Other thing I just want to look at here is oil. Oil's had a nice little breakout in the last couple of days. If I can just bring up the chart. So I'll bring up the front contract here. What you can see here again is that on the daily chart here, you can see we're now between the 100 and the 200-day EMAs. So we had a nice bounce here at that low. It couldn't get below that sort of recent low here, and it's now bouncing up. So it's come up $2 or $3, not a massive amount, and that's just basically because we saw yesterday from Russia that they're actually underproducing. So they're producing less oil than their OPEC plus quota, and it's becoming increasingly more difficult, problematic, complex for them to ship their oil, to export it, to get it to the Chinese and the Indian refineries, because as you guys remember, in the final hours of Biden's administration, they imposed pretty serious sanctions on the Russian sort of tanker fleet and insurance companies and whatnot. So just logistically much more difficult. So the point is, it feels like some of these American sanctions are actually starting to really work in the physical market. And we saw over the weekend, as I think I mentioned yesterday, that the official selling prices, the OSPs, for the grades of oil coming out of the Saudi Arabia, from Iraq, from Dubai, they're all they've jacked up the prices. They've raised the prices to the Indian refineries and the Chinese refineries. So the point is that the physical market, especially in Asia, seems to be quite tight, and that's obviously bleeding over here into the WTI market. So what's going to be interesting here, if we just break this down on a 4-hour chart, just sort of technically. What I've got here, we've got this earlier fib. So if you just look at this very short-term one here, so drawing the fib from here, this little impulse here, you can see that we broke above that. So that's a positive. So we'll get rid of that one. And then if we now look at a slightly longer-term fib, which is going from this impulse of the 2nd of February, pretty critical area here, because on the 4-hour, you can see we're just above the 100 and the 200 periods, moving average. But also we're at the 61.8 Fibonacci retracement here. So from the bull's perspective, it doesn't really matter if it kind of comes back, 10, 20, 30, 40 ticks. But the bulls would probably want to see any pullback here basically bought in order for it to push higher. And then, of course, what would be the next step would be on the longer term fib, which we would have to try and get up to these levels here, which would be the 38% fib retrace at about 74.30 on the front contract. Not quite there yet. We shall see. But so far, this is a relatively positive price action. The other thing as well, apart from the physical market and potential tariffs, not tariffs, I'm thinking too much about tariffs, sanctions on Iran is also that we saw yesterday there were some unhappy developments in the Gaza. Trump continues to treat it as a real estate deal. But basically, Hamas has sort of temporarily suspended the exchange of hostages until Saturday. Trump is basically saying that unless and until hostages released by 12 o'clock on Saturday, quote, all hell will break loose. So just a lot of geopolitical tensions there suddenly. Could we see the reignition of hostilities between the Israelis and the Palestinians? That would be very sad and unfortunate, but it's possible. Now, we all know that no oil comes from the Gaza Strip or Israel, but the reality is any, up ramping in tension in the Middle East is possibly also underpinning the oil price. Okay, so other things happening today. We don't really get any data, but we do have Jerome Powell in front of the Senate. It's interesting. So he's giving his biannual Senate Humphrey Hawkins testimony today at 10 o'clock, and then in front of the House of Representatives tomorrow. And what's interesting is that tomorrow we actually have the CPI report at 8:30. Powell will be speaking at 10 o'clock. Normally the second day is essentially a rinse and repeat, copy paste of the first day. But the fact that we have CPI could be interesting tomorrow, especially to see if Powell has any reaction if we get the CPI going down or going up, and see if that changes his testimony. Just bear in mind that he does have introductory remarks, which sometimes do come out before 10 a.m. when he officially starts the process. I've seen them in the past come out sometimes at 8:30, 8:45, 9 o'clock, just a bunch of headlines. What the market wants to know, he's going to be peppered about tariffs and Trump and inflation, and is Trump causing inflation, et cetera, et cetera. I think there's a lot of political theater. We know the Democrats are going to probably hammer him on DEI, the fact that the Federal Reserve is actually sort of dismantling its DEI initiatives. But really, from a market perspective here, the market wants to, the market wants to know, but the politicians will probably be peppering him with questions such as, have you factored in Trump's sort of tariffs? Do you think that tariffs will be good for the American people, good for the American economy? Will it be inflationary? Now, what we've seen so far from Mr. Powell has essentially been no comment. I think what he's probably going to say is he's going to try and be boring and say, well, listen, we will only react to concrete policy actions. We are not in the fiscal space. That is for elected officials, as he likes to say. And so I think he's going to try and keep a poker face here under probably quite a lot of abuse and pressure. So we'll see how he reacts to that. So the market will be listening for any sense of what he thinks about the forward path of inflation, and specifically his interpretation, if he decides to say anything, about the potential impact of potential Trump tariffs. Personally, I think he's going to play it with a very straight bat, as we say in Australia for cricket. You non-Australians won't get that, but like very defensively. He's going to be very conservative and defensive, and essentially say, when we get more information and specific tariff policies, we will include those in our modeling. Anyway, that's something definitely to be looking out for. We also have a 3-year auction. We can see that if we just actually look at the bond market, it's been pretty stable, but we're starting to get some weakness at the front end here. And you see this is the 5-year, you see the 10-year and the ZB. So we do have auctions. We have the 3-year today, we have the 10-year and the 30-year tomorrow and Thursday. So this could just be a concession being built in. So the price comes down, the yield goes high, which makes it more attractive for the market to buy. But definitely bonds are coming off at the moment. And possibly this is just on this idea. We now have the apparently confirmed tariffs on steel and aluminium imports, which all things considered will make those industrial processes more expensive, which of course is inflationary. So interesting there that's what we're getting. We're getting a bit of a sell-off in the bonds here. Just a couple of other things just want to say, guys, is just keeping an eye on New Zealand dollar. I've got a little note here on some of the currencies here. So as I say, we see that the US dollar is actually not reacting that well to higher tariffs. Higher interest rates. So we see that the US yields are up, but the US dollar not reacting. And we also see tariffs and the US dollar actually coming off, if anything, at least the dollar index. So the market, I think, is starting to turn away and say, these tariffs and there's sort of the lack of certainty and indeed chaos coming out of the the White House and cutting jobs and Doge and Musk and everything, is this actually leading to a situation of uncertainty, which is a negative medium term for the US economy and maybe even going to be a drag on growth? Higher prices of steel, aluminium, less workers, less government spending. On one hand, that's kind of good to have less deficits, but it's also potentially going to be a drag on growth, a negative for growth. And maybe we're starting to see that here in the US dollar. Interesting. Just what I was saying about the Aussie dollar here. Aussie dollar, potentially about to break out here. It's sort of interesting just because we obviously have to keep an eye on sort of China and tariffs and whatnot. But just keep in mind that as Australia only exports 3% uh, of its GDP to the US. So it's relatively, even if Trump whacks some tariffs on Australia, it's really the China story. And at the moment, Trump does seem to be stepping quite delicately around China. I mean, there's 10% and retaliatory tariffs, but nothing nasty. And we just see the Aussie starting to push up a little bit. And what I want to draw your attention to is just to compare that to New Zealand dollar, which is trading a little heavier. And maybe that's because New Zealand is a bit more exposed to the US in terms of trade, about 11%. So Australia has about 3% going to the US in terms of exports. New Zealand is more exposed with about 11% of its exports going to the US. So any tariffs would adversely affect New Zealand more. So we could see also something like Aussie New Zealand, sort of breaking out. In fact, we're already seeing that. So you're seeing that that's a pretty strong one. Actually, just interesting to see on a longer term chart here. We'll put it on a daily. So a little bit more to go there, breaking out of the range. And you've got to say that quite possibly, let me just put a little box on this one here. So it could be some more upside to Aussie New Zealand. That looks like that's happening there. Okay, guys, I'm going to leave it at that. Not a huge amount to say about equities at the moment. Just trading in a trade box, trying to get a bit more clarity about the Trump tariffs. Okay, so I'll leave it there. Keep an eye on gold. Very interesting. We've got Powell. Let's see what's going on there. I'm going to keep also an eye on oil. We've got the auctions. Let's see if they're digested well, because what could happen is that once we get through this auction cycle, as I say, Tuesday, Wednesday, Thursday, the 3, 10, and 30 year, we could get a little bid because at that point those yields start to look quite interesting for some of the big players. I'll leave it there, guys. Have a great day, and we'll keep on talking. Thank you.